Imagine this for a moment. Margaret is 72 years old. She's sitting at her kitchen table on a quiet Tuesday morning. Her coffee is getting cold. In front of her is a letter from a tax attorney, and her hands are shaking. 2 years ago, her husband passed away, and 6 months after the funeral, her son sat her down and said, "Mom, let's just add my name to the house. It'll make things easier when. So she did it. She went to the county office. She signed the new deed. It cost her about $40. She thought she had just done the smartest thing of her life. She thought she had just saved her family from probate, from lawyers, from headaches. But the letter in front of her right now says something different. It says that one signature, one trip to the county recorder's office, may have just cost her son over $90,000 in federal capital gains tax. $90,000. Gone. On a house she already paid for. And here's the part that breaks her heart the most. She can't undo it. Hello, my friend. I am Misha, Senior Policy Analyst here at TaxWise Seniors. And today I need you to put down whatever you're doing and listen very, very carefully. Because if your name is on a house and your child's name is also on that deed, you are sitting on what the IRS calls a carryover basis trap. And in 2026, with home values where they are right now, that trap is bigger and more expensive than it has ever been in American history. Today, I'm going to walk you through 3 things. First, I'll show you the exact rule the IRS uses, in plain English, no legal jargon. Second, I'll tell you the story of a real situation that happens to thousands of seniors every single year. And third, I'll give you the 3 specific steps you must take this week to protect your home and your children's inheritance. And please, stay with me until the very end. Because there's one mistake I see seniors make over and over again, and it's the mistake that turns a $40 deed change into a 6-figure tax bill. I don't want that to be you. So let me tell you about Robert. Robert is 68. He worked 34 years as a postal supervisor in Ohio. His wife, Linda, retired from teaching. Together, they raised 2 kids in a 3-bedroom colonial they bought back in 1982 for $52,000. Today, that same house is worth $480,000. Robert is a careful man. He reads, he plans, he watches videos just like this one. And one day, his neighbor tells him, "Robert, you should add your daughter Jennifer to the deed. That way, when something happens to you, she just gets the house. No probate, no court, no lawyers." Robert thinks about it for a few weeks. It sounds smart. It sounds safe. So he goes down to the county courthouse, pays the small recording fee, and adds Jennifer to the deed as a joint owner. He goes home and tells Linda, "Honey, I just saved our family thousands of dollars." 6 years later, Robert passes away. Linda, heartbroken and now in her 70s, decides the house is too much to handle. So she and Jennifer agree to sell it. They sell for $480,000. Clean sale. No issues. Then tax season comes. Jennifer's accountant calls her and says, "Jennifer, you owe the IRS about $68,000 in capital gains tax, plus state tax, plus the net investment income tax." Jennifer almost drops the phone. She says, "But it was my dad's house. I inherited it." And the accountant says the words that every senior watching this video needs to hear right now. "No, Jennifer, you didn't inherit it. Your father gave it to you back in 2020 when he added you to the deed. And under IRS Rule Section 1015, that means you took his original cost basis. You took the $52,000 he paid in 1982, not the $480,000 it was worth when he died." That, my friends, is the trap. So let me explain exactly what happened in the simplest words I can use. The IRS has 2 completely different rules for how property gets passed down, and which rule applies depends entirely on one thing: whether you transfer the home while you're alive or whether your children receive it after you pass away. Rule number 1 is called stepped-up basis. It's in the tax code under Section 1014, and it works like this. When a child inherits a house after a parent dies, the IRS resets the value of that house to whatever it's worth on the date of death. So if Robert had simply left the house to Jennifer in his will, The basis would have stepped up to $480,000. Jennifer sells it for $480,000. Her taxable gain is zero. $0. Zero tax. That's the gift Congress gave to American families. Rule number 2 is called carryover basis. It's in the tax code under Section 1015. And this is the rule that crushes seniors who add their kids to the deed while they are still alive. Under carryover basis, when a parent gives property to a child during their lifetime, the child does not get a fresh start. The child inherits the parent's original purchase price. Whatever you paid for that home back in 1975, or 1982, or 1990, that's what your child is stuck with. The IRS confirms this in Publication 5551, the Official Basis of Assets Guide, December 2025 edition. It says clearly, to figure the basis of property you receive as a gift, you must know its adjusted basis to the donor just before it was given to you. And here's where it gets worse. When you add your child's name to your deed, the IRS does not see that as a small administrative change. The IRS sees it as a completed gift of half the value of your home. Right then, right there, on the day you sign. If your home is worth $400,000 and you add one child to the deed, you have just made a $200,000 gift in the eyes of the IRS. And that triggers another problem. In 2026, the annual gift tax exclusion is $19,000 per recipient. Any gift over that amount requires you to file IRS Form 709, the United States gift tax return. Even if you don't owe a single penny in tax, you still have to file the form. Most seniors never file it. They don't even know it exists. And the IRS penalty for failing to file Form 709 is 5% of any unpaid tax per month, up to 25% plus interest. And here's the kicker. The statute of limitations never starts running until you file, which means the IRS can come after that gift 20 years later. Now, I know this is heavy. Take a breath with me, because I want to tell you something even more important, something AARP itself has warned seniors about for years. In a published article on AARP.org, financial advisor Patricia Hausnost said this, and I want to read it to you exactly. She said, "Some parents are tempted to transfer title of the house to their children while the parents are still alive. Don't do it. The heirs will be responsible for the house expenses, including liability, and they won't get the step up in basis." That's AARP. That's not me. That's not some random blog. That's the largest senior advocacy organization in America telling you, in plain English, do not do this. But here's what they don't always tell you. The capital gains tax is just the first consequence. There are 4 more, and they are just as dangerous. The second consequence is loss of your Section 121 home sale exclusion. This is the rule that lets a married couple exclude up to $500,000 of gain when they sell their main home. But once you add a child to the deed, that exclusion only applies to your portion. Your child's portion is fully taxable, unless they've actually lived in the home as their primary residence for 2 of the last 5 years. The third consequence is Medicaid disqualification. Under federal law, 42 U.S.C. Section 1396P, there is a 5-year look-back period. If you apply for Medicaid long-term care within 5 years of adding your child to the deed, the government treats that as an uncompensated transfer. They calculate a penalty period during which Medicaid will pay nothing. Nothing for the nursing home, nothing for memory care, nothing. The fourth consequence is the one nobody talks about. The moment you put your child's name on that deed, your home becomes legally exposed to your child's problems. If your son gets divorced, half his interest in your home can be claimed by his ex-spouse. If your daughter gets sued, the plaintiff can put a lien on your home. If your child files bankruptcy, their share goes into the bankruptcy estate. You did not create that risk for yourself. Your child did. But your home pays the price. And the fifth consequence, and this one is the worst, is that you cannot undo it. Once that deed is recorded at the county office, your child is a legal co-owner. To remove them, they have to sign, voluntarily. And if they refuse, or if a creditor has already attached to their share, you may be locked into a situation you cannot escape. Now, I know what some of you are thinking right now. Misha, this is terrifying. What am I supposed to do? My name is already on a deed with my son. Or I was about to do this next week. What do I do? I am going to give you 3 exact steps. Write them down. Pause the video if you need to. Step 1. Before you change anything on your deed, contact a qualified estate planning attorney in your state. Not a general lawyer. Not your cousin who does real estate. An estate planning attorney. The cost of a 1-hour consultation is usually between $200 and $500. That consultation can save your family $100,000 or more. AARP has a free legal services directory at aarp.org/money where you can find local resources. Step 2. If your goal was to avoid probate, ask your attorney about 3 specific legal tools that preserve the stepped-up basis. The first is a transfer on death deed, also called a beneficiary deed, which is available in most states. The second is a revocable living trust. The third, if you live in a state that recognizes it, is a life estate deed with retained powers, sometimes called a ladybird deed. All 3 of these accomplish exactly what adding your child to the deed was supposed to do, but without destroying the step-up in basis under IRS Section 1014. Step 3. If you have already added a child to your deed, do not panic, but do not delay either. Schedule a meeting with an estate attorney and a CPA together. There may be options. You may be able to remove the child from the deed if they agree. You may need to file a corrective Form 709. In some cases, depending on how the deed was structured, you may still qualify for a partial step-up if you retained certain ownership rights. But every month you wait is a month the situation gets harder to fix. And now, my friend, here is the hidden mistake I promised to tell you about at the start of this video. The biggest mistake seniors make is this. They assume that because adding a child to the deed is legal, it must be safe. They assume that because the county recorder didn't warn them, there must not be a problem. They assume that because their friend or their neighbor did it, it must be fine. But the county recorder is not a tax advisor. Your friend is not the IRS. And legal does not mean smart. The IRS will not call you to warn you. They will not send a letter saying, "Hey, you might want to reconsider this." They will simply wait. They will wait until you or your spouse passes away, until that home gets sold, and then they will send a tax bill to your child for $60,000, $80,000, $100,000. And by then, it is far too late to fix it. So please, please hear me on this. Do not rely on YouTube notifications to keep you informed about tax law changes. Do not rely on your neighbor's advice. Do not rely on a one-page article you found online. Go to irs.gov and look up Publication 551 and Publication 523 yourself. Go to aarp.org and read what they say about estate planning. And most importantly, talk to a licensed estate planning attorney in your state before you sign anything that changes the ownership of your home. Your home is likely the largest asset you will ever own. It is the foundation of your family's financial future. Please do not give it away with a $40 trip to the county courthouse. If this video helped you today, do me one favor. Share it with one other senior you know, one friend, one sibling, one neighbor. Because somewhere out there right now, there is a Margaret or a Robert about to make this exact mistake, and you might be the one who saves them. I am Misha, with TaxWise Seniors. Thank you for trusting me with your time today. Stay informed, stay protected, and I will see you in the next video.